These two are the important aspect of investment analysis: risk analysis and return analysis. Risk analysis I have discussed on last term, and today I will start return analysis. This is one of the important component of investment, and every investor wants to maximize return. But how to maximize return? A student must know. A student must know the procedure and the kind of knowledge they need to have, and how to analyze, how to investigate profitability aspect of every investment. As far as profitability aspect of investment is concerned, you have to rely on accounting data, like you have prepared profit and loss and balance sheet, and on the basis of profit and loss and balance sheet, number of ratios you have to calculate. You have studied ratio analysis. You have studied, yeah, ratio analysis, like gross profit ratio you have studied. So number of profitability ratios you have studied in ratio analysis. Number of profitability ratios you have studied. Now question is, from investment point of view, which ratio is more important from investment point of view? Gross profit, gross profit will show you, gross profit ratio will show you how much is the gross profit margin after deducting cost of goods sold, that is direct expense. If you deduct total direct expenses from the sales, that is cost of goods sold, you will be getting gross profit margin. And gross profit margin is not including indirect expenses. Only direct expenses are included. So gross profit is not the actual return on investment if you have planned to do in any company. We have another profitability ratio, that is called operating profit. Operating profit ratio. Operating profit. Operating profit ratio. You must know what for it is calculated. Again, this ratio is not important for investors, those who are interested to make investment in the company. Operating profit is calculated to know the managerial efficiency of the company. And operating profit is showing the profit which is generated from core activities of the business. Suppose there is one construction business. So operating profit means the profit generated from construction business only. Normally it happens in profit and loss account. Other incomes are also shown, like income from investment, rental income, which is not from the core business activity. So operating profit is calculated to know how much is the core profit, or how much is the profit from the core activities of the business. Then we have net profit. Net profit ratio also you have. All of you have calculated net profit ratio, or you have calculated net profit. And you must know why net profit is calculated. Net profit is calculated due to legal requirement. It is mandatory for all the business units in the country to show net profit, as government has to impose taxes on net profit. Government is government is imposing taxes not on gross profit, not on operating profit, but on net profit. And net profit includes income from core operation as well as income from other sources. And it includes expenses not only related to business, but other expenses which have been incurred. So all the expenses minus all the incomes minus all the expenses, you will be getting net profit. And on net profit, companies or firms have to pay tax. So net profit is one of the requirement for a company in order to calculate taxes, which is mandatory by the government of India. Are you listening me?
Yes, sir.
Okay.
Yes, sir.
Is it clear so far what I have discussed?
Yes, sir.
I'm discussing, you have studied number of profitability ratios. Which one is more important for you? Then we have return on investment ratio. It means whatever investment has been done in the company in the form of capital and how much income has been generated thereof. Capital employed means how much fund has been raised by issue of debentures, by preference shares, by equity shares, or how much loan has been borrowed, which is forming capital. And that capital has been introduced in the business. So from this, how much has been the return to the company? So again, if you are the investor and you have purchased equity shares, then return on investment, whatever is the ratio, it is 30% or 25%, it will not be profit of equity shareholders. If you want to invest in a company and return on investment ratio is not your profit, then we have return on assets. Again, this ratio is calculated to know how efficiently assets are used. What about earning generated from using the assets? So again, whatever is the return on assets will not be the return to equity investors. We have return on common stockholders or equity. Return on equity. Again, suppose you have not invested, you want to make investment, you want to take investment decision, then again, whatever is the return on equity will not be the expected return by you. You should not expect this thing. Return on equity is the return to existing shareholders. Those who are already shareholder of the company, they will be getting this return. And equity shareholders get return after payment of interest, tax, and preference dividend. So if you deduct from the net income all the three items upon total stake of the equity shareholders, so you will be getting return on equity. Then we have earning per share. Whatever is earning left for equity shareholders, entire earning is not distributed to equity shareholder. Certain amount is distributed and certain amount is kept in the form of reserve. Certain amount is transferred to some of the contingency reserve or certain general fund or some other funds, and certain amount is transferred to balance sheet for reinvestment, and certain amount is in the form of dividend. So whatever is the earning, total earning, total earning divided by number of shares, so you will be getting earning per share. Okay, and whatever is the earning per share, I'm discussing EPS, earning per share. Then whatever is the earning of the company, entire earning is not distributed, certain amount is distributed in the form of dividend, and remaining amount is kept by the company in the form of reserve and surpluses or funds. So again, dividend payout ratio is not the real income of the investor. From investment point of view, this ratio is very important. Whenever you have planned to invest, whenever you have planned to invest, you have to go for PE ratio of the firm. PE ratio means suppose you have planned to invest and you would like to know how much return you are likely to get. What you will do, you will buy shares, you will buy share of the company. So you will be getting share at market price. So market price will be your investment and earning thereof. Suppose market price is rupees 100, on 100 is your investment and how much return you are getting on 100. So that is the real return of equity shareholder or being investor. And how it is calculated, again you must know very well. Suppose current market price of the stock is rupees 50. Today price of any stock is rupees 50 in which you have planned to invest, and you want to calculate how much will be your likely return at the end of the year. Today its price is rupees 50. and you are expecting dividend during the year 20%. How you are expecting 20%? It has been the trend of the company to distribute around 20% dividend. Suppose during the current year, on the basis of past record or estimation, you came to know that 20% dividend you are likely to get during the year. Face value of the stock is rupees 10, which is prevailing at 50 in the market. And again, you are expecting 20% appreciation in the stock price at the end of the year. So how to calculate PE ratio? So your investment is 50. 50 will be denominator. And on 50, how much return you are likely to get? See, dividend is given 20%. So how much will be the value of dividend? Amount of dividend, anyone? How much will be the amount of dividend? Yes. How much will be the amount of dividend?
Can you please,
Yes.
hello? Can you please repeat?
How much?
Can you please repeat?
Market price of the share is 50 rupees and dividend you are likely to get 20%. So how much dividend? And face value of the stock is 10. So how much dividend you are supposed to get?
Can you please?
Dividend is always declared on face value. Market price may be anything. You will not be getting
That means 2%, 2 rupees.
on page 2, you will be getting dividend. Okay. So 50 rupees you have invested. On 50 rupees, rupees 2 you will be getting dividend. And market price of the stock is likely to appreciate by 20%. So it means 10 rupee growth in the market price you are likely to get. So 10 plus 2. Expected dividend 2 rupees. Gain in the stock price 10. That is 12. And how much you invested? 50. So 12 is the likely earning on investing or on investment of rupees 50 into 100. So that will be 24% PE ratio. Okay, is it clear?
Yes, sir.
Apart from this, apart from PE ratio, you may also go through trend analysis. If you want to measure how much returns you are likely to get, you can go through the profitability or income or revenue of any company, and you can see the trend of the past, and accordingly you can make projection. So trend analysis or graphical projection is also used to know or to measure the likely income. Then you have studied break-even analysis in cost accounting or in management accounting. You have studied break-even analysis can also be used for profit planning. You can go through break-even analysis of any company, and on the basis of unit sold, on the basis of unit sold at different level of output, different revenue and different profit and loss is depicted in this chart. So accordingly, you may think how much profit company is likely to get, and accordingly you may expect. A layman is not knowing, but on the basis of analysis of output, cost, revenue, or production analysis of any company, easily you can know how much will be the likely profit of the company, and accordingly you may ascertain, accordingly you may analyze how much return you will be getting. Okay. I'm just giving you the various tools which are used to measure return. You also have studied financial leverage, degree of financial leverage. Every company is having debt equity mix, and debt equity mix vary from one company to another company. And due to debt equity composition, if there is any income, suppose income is 15% and debt equity ratio is 50-50, then return to investor will be something. And if debt equity ratio is 60-40 and earning is 15, then 15 will not be the return to equity investor. Equity investor will be getting different return due to debt equity mix. So you can study, you can analyze debt equity composition of any firm, and accordingly you may ascertain how much return you are likely to get. Similarly, there is operating leverage ratio. Operating leverage means suppose you came to know expected increase in sales of a company is 20%. So do you think 20% will be the change in profit? No. It depends upon fixed and variable cost composition of the company. And this fixed and variable cost composition vary from company to company. So even if sales is 10%, it doesn't mean there will be change by 10% in the income due to different fixed and variable cost composition. Whatever is the change of sales, change in operating income will be different. So on the basis of debt equity composition, you may calculate operating leverage ratio, and accordingly you may ascertain the likely return you are likely to get being an investor. Then some statistical tools are also used like mean, median, mode, range, etc. are used. Standard deviation, quartile deviation, mean deviation, all these are also used to analyze the data. Statistics is all about collection, presentation, tabulation of data for making interpretation. So if you have data of return or sales or profit of any company, you may calculate mean, median, mode. Accordingly, you may analyze the things. Now this one is important from investment point of view, geometric mean. And you must know where geometric mean is used. Geometric mean has limited use. Its formula is 1 plus R1. R1 stands for return relative. Suppose you invested rupees 10 or rupees 100. First year you are expecting 50 rupees. So return relative will be 0.5. 1 means your principal amount and how much return you are expecting. If it is 20%, then 0.2. If it is 40%, then 0.4 will be the R1. Similarly, for second year, for third year, for fourth years, for n number of years. Bracket close -1. I will give one example. Suppose the price of the stock increased by 100% at the end of first year and declined by 50% at the end of second year. What is the average return of the stock for these 2 years? So a layman will calculate 100 profit for the first year, then minus 50. Minus 50 will be the profit for second year. So total profit will be 100 minus 50 is equal to 50 divided by 2. That is 25%. But 25% will not be the return. You have to use geometric mean. In this case, 1 plus R1. First year, market price of the stock was increased by 100%. So whatever is the principal amount is 1 suppose, then return relative is also 1. 100% means same. 1 plus 1, 2. So 100 rupee invested in the beginning, at the end of the year, it will be 200. It will be 200 into return relative of second year, that is 1. And there was a decline of the share price or stock price by 50%. So minus 0.5. So in this case, 1 plus 1, 2 into 1 minus 0.5 is equal to 0.5 minus 1. So 2 into 0.5, that is 1, minus 1 is equal to 0. So in this case, geometric mean will give you exact, and geometric mean is used when you have to calculate average, where values are given in terms of growth percentage, where values are given in terms of growth rate, growth percentage, then you have to use geometric mean. Okay, this example is clear to you?
Yes, sir.
See, in investment, whatever you are expecting in future, actual amount will go from you now whenever you are investing, but returns you will be getting after 1 year, 2 year, 3 year, or in future. So all future earnings which are looking, suppose 2 lakh rupees you will be getting after 2 years, and 2 lakh rupees you are getting now. So whatever you are getting now, whatever present value of income you are having, it has more value. Whatever you are getting after 2 years, due to inflation, value of the money will decline. So all future earnings you have to discount. All future earnings you have to discount. Like this formula, which you have studied in compounding interest, future value you want to calculate is equal to present value. If you have notebook, you may write. You write in the notebook, present value, suppose you have 2000 rupees. You write 2000 rupees in place of PV into 1 plus R is suppose 10%, 10 upon 100. 100 rupees given to you now, easily 10% you can earn without taking this. But this 10% you will be getting after 1 year. If I say take 100 rupees now or 100 rupees after 1 year, which one has more value? 100 rupees now and 100 rupees after 1 year. Which one has more value?
Present value.
Present value. Why it has more value? Because if you have
Because of, sir, inflation.
if you have 100 rupees now, you can deposit it to bank. Okay, and bank you suppose 10%. So after 1 year you will be you will be having 110. It means 110 after 1 year or 100 now have same value, right?
Yes, sir.
100 now or 110. It means after 1 year, if you have 110, this future value is given to you, and you want to calculate present value. What you will do? Present value is equal to FV upon 1 plus R power n. Okay, 1 plus R power n will be numerator. Sorry, denominator. So you will get 100 rupees. Suppose after 1 year you are getting 110. What about its current value? So its current value is 100. It has been shown in this chart. If you are getting something now, it has same value. But if you are getting something after 1 year, you have to discount. Suppose 100 rupees. So 100 upon 100, 1.1. After 2 years, 100 upon 1.1 power 2. After 3 years, 100 upon 1.1 power 3. Like this, you have to discount. Okay? Then only you
Yes,
can
sir.
compare it is profitable or not. Okay, Hardik? Is it clear?
Yes, sir.
Now, in case of normally when we invest, then analysis is required not in all kind of investment avenues. Suppose you have invested in bank deposit. Do you think you need to make any analysis to calculate your return? Do you think you need to make any effort to calculate the return?
No, sir.
No. Similarly, in case of debentures, bonds, post office deposits, insurance, because return is assured, return is well known, it is predetermined. So you have not to calculate, you have not to make analysis. Only in certain cases when debentures or bonds are issued at discount or at par or at premium for a certain period of time, and at the time of redemption, amount may be at par or maybe at premium. So what you have to check, just like in this example, a bond was purchased at rupees 90. So 90 will be your investment. So you will write as denominator 90. On this 90, how much return you are likely to get? Suppose 13.5% interest you are likely to get. That is well known in the beginning. So 13.5 is your return. And at the end of first year, it was issued, for example, for a year. 95.4 you are getting. So 5 rupee 40 paisa more amount you are getting. So 13.5 plus 5.4. 13.5, 18, 18.9. So 18.9 upon 90 into 100, that is 21. So 21% or 18.9 in terms of rupees. Rupees 18.9 is the return in terms of rupees, or 21%. Okay. But this return, okay, Hardik,
Yes, sir. Yes, sir.
but this return of 20%, 21% or 18.9, you will be getting after 1 year. After 1 year, this is future value.
Hmm.
And actual investment you are making now. So all future earnings you have to discount using this formula. Suppose you have invested in bond or debenture or any other security where assured or fixed return you are getting. So whatever you will get after end of first year, that is called coupon amount or interest rate amount. So that amount will be discounted by 1 plus I, the rate of interest which you can easily earn without taking risk. Currently it is 7%, which is offered by the bank. So 1 plus 0.07. Whatever amount you get second year, that amount you will write. Then 1 plus 0.07. So 1.07 square. Whatever amount you get third year, that amount you will write upon 1.07 power 3. And at the time of maturity, interest amount plus principal amount is redeemed. So that total amount you will write at par or at premium, whatever it is, you will write total amount divided by 1.07 power n. Okay.
Yes, sir.
So this is about return analysis. And if you want to discuss, anything, if you want to ask, is it clear what you have to do?
Sir,
Yes, yes,
I have a query, sir.
yes, yes.
Sir, when you were talking about operating profit ratio,
Okay.
and correct me if I'm wrong, I heard you said operating ratio is calculated by construction businesses only.
No, no,
And
no,
if this is the
all.
case, then
I gave example only. Operating profit means
okay, okay,
profit from the core activity of any business. If it is
okay,
IT
okay, sir.
company, then profit from IT business,
Okay, okay, sir.
right? For example,
Okay, sir.
I am a CA. So my
Yes, sir.
income, suppose I am a CA, chartered accountant,
Yes, sir.
and I have a firm. I have to pay tax on my income. So my job is to give consultancy services. So how my
Okay, sir.
business is going on as a CA? I would like to know my operating income, total income generated from
Okay.
my consultancy services. But if I have some other
Okay, sir.
property, other investment, I have got a lot of interest and dividend and rental income from properties, and I include all those in my firm's income, then my firm's income will be different,
Oh,
right?
yes, sir. Definitely. Yes, sir.
Any other question?
No, sir. Thank you.